Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us as we try to figure out what's happening year-end here. We're into the last quarter, Q3, October. Welcome to everybody here, and thank you for listening to the show. If you want to see the show, go to YouTube. We've been on YouTube for a decade or more. Jeff Barton, the Mortgage Voice, that's how you can see and hear me all the time. Anytime you miss this weekly that we do on KCAA, and that's our radio station out there in the Inland Empire. I want to say hi to them and Fred and Mark and all the people out there. Appreciate the work they do bringing us to you. San Bernardino and Riverside, very interesting market, both real estate and mortgages, which we will get into. And again, I am Jeff Barton, and this is the Mortgage Voice. Before we get the news to use and all that other stuff, there's so many times where you're trying to figure out your next move, whether you're going to buy, whether you're going to rent, if you can afford it, what is the financial calculations, all the things you have to do in order to really figure out what's your best move when it comes to housing. And housing is the number one issue for many, many people. And as we tour around and look at the different cities around the country or different towns, the unhoused population that's out there, all this is affecting the psyche of the individual who wants to live in a particular neighborhood, who needs a place to go and call home, right? So in many of these instances, the distraction of the focus becomes immense, great, grand. Okay, yesterday I got a call from an agent of mine. I am also a real estate broker, as everyone well knows, and the agent was talking about putting in an offer. Actually, they had put in an offer and they had come back with a counter offer, the seller had, and just to try to figure out exactly the motivations of the seller, the amount of contingencies that they can work with as a buyer. All of these things were basically about the deal, and the deal itself was really important to both sides. The questions of what's in the deal, can you trust the HOA? Are there extra expenses? Can you remove some of the contingencies? Do you want to up your price? All of these things you need to talk about, obviously, with your agent or with your, significant others, your banker, your mortgage broker, whoever it is. This is a team effort to get where you want to go, which is home ownership. So I am listening on many of the social media ways that people get their information, whether it's TikTok or whether it's Facebook or whether it's Instagram or LinkedIn or, there's hundreds of them. Let's face it. If you go online right now, you're in an online community, and I don't care what you're looking at. Somebody else is trying to pollute your mind with information that is either useless, non-functioning, or a total lie. So I'm listening to a person today describe the efforts that people are making around the world to stop the world from heating up. Now, I don't know whether you are on one side or the other of this particular issue. It's unimportant based on, the focus that I need to have, which is on helping people get from A to B in the real estate market. How do I figure out what their concerns are, and how do I solve those concerns and get into either a property or a mortgage? This is what I'm thinking about. So this person was on and on about, it's all a lie, it's all a fake, and it's all a bunch of things. Now, as is often when I get provoked, I want to respond, and I try to go snarky. I don't know, a lot of people don't do that, but I do. There's no point in arguing, with people who you disagree with. It's better just to come up with something funny. But I couldn't help myself. I wrote it out, texted it out, and I said, no, I'm not doing it. And I deleted the whole thing. And later on, I'm driving to the show where we're recording today, and I thought, okay, what would have been the best answer? And the best answer, of course, is, it's all a lie. The whole thing. What you're saying is a lie. What we're saying is a lie. How can you quantify 6.5 billion or whatever it is of Earth existence into some data points for the last 30, 40, 50, 100 years, whatever it is? You can't. So the next brilliant thought in my head is, so what is the difference? Well, the difference is that, like me, many people get caught up in this and they lose focus on what you need to focus on if you're trying to get a home, if you're trying to get housed, if you're trying to get a rental. Now, yes, prices have gone up. Did we predict they would go down this year? Yep, you betcha. I did. I confess, I did it. I said at the beginning of the year that house prices would probably go down because the demand for housing would shrink because the mortgage interest rates were going so high. And I still think that that's somewhat true. The things that I did not really grasp a hold of was that inventory itself would shrink. And it year over year, and I've got some numbers here and I can share them with you in the next segment, but interest rates themselves have gotten so high that people have stopped the pursuit of housing. And because fewer and fewer people are moving, why? Because during the pandemic, 3% mortgages, that's what you could have. Let's say you followed the thing down, right? It was at 6 and then 5 and then 4 and then 3. You could have really refied, and because equity kept gaining, taken money out of your property and had a lesser payment and had more money in your pocket when it was 3% versus obviously when it was 5%. Now that has never happened in the history of mortgages that I know of. Or has it happened that we have a simultaneous reduction in the amount of properties for sale, a raising of the interest rates, and the prices of that real estate going up as a result? It's really never happened like this. And I think that's why there is so much intense focus on, are we going to be in a recession? Are we not going to be in a recession? Are we going to do the dreaded, a recession whereby we see, hundreds of thousands of people laid off? Okay, let's get into it. Just a couple of numbers here. Today was a jobs report that came out. Now, for the last, I don't know how many months, we've had positive job growth in this country. This month, 336,000, this is September, jobs were created in the month of September. That is summer months in terms of the amount of people, but they were predicting like less than 200,000, 180, 160. Nope, double that, 360, which is phenomenal. Now, why is that happening? And how does it affect your decision making? It should make you feel good, first of all, that the job you're in, you're probably going to be able to keep, because if they're adding jobs, obviously your job is probably still worth something. It's not like the company's cutting because they need to save money because their business is doing so bad. No, this says business is actually doing pretty well, that enough people have been hired, they still need more people. And there's 8 or 9 million jobs still out there that need filling. Now, the problem in all this is obviously the inflation, right? And we've talked about the inflation forever. We've seen the Fed rate go from a quarter point all the way up to 5.75%, probably go up one more time this year, maybe around 6%, 5.75 to 6%. That's where we're heading. And because of this continued raising of the short-term interest rates that the Fed charges the member banks, we expected to see unemployment go down. Didn't happen. Just the opposite happened. We expected to see more plentiful housing. Didn't happen. Just the opposite happened. All of this is as a result of two things, according to either Jamie Dimon, who's head of Chase, or who else? There's Mohtashami, who is a Housing Wire economist. Read a lot about what he has to say. And, of course, there's Larry Summers, who's always out there on Bloomberg, as another person who talks about the economy. The reason all of this is happening is because government stimulus. Now, we know from the discussions I have, and I'm a China guy, right? So I talk about it all the time as to be a way by which that country runs their economy. It's stimulus by the central government, which has driven the demand of housing in that country. Here, it's been the opposite. It's consumer-based demand. That's what's driving the economy. Anyway, we got a lot to talk about today. I have some great guests for you. Terrific show. Glad you came. I'm Jeff Barton. This is The Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, if you want to see this show, we got a great website, themortgagevoice.com, where I am featured prominently, but more importantly, you can go there to find the guests that we have on the show, hear and see what they're doing and what they have to say. Plus, you also have some contact information there, and if you wanted to talk to them directly without any interference, you can do that. They have email addresses and other things that you can use really easily and get in touch with them. So themortgagevoice.com. I'm Jeff Barton, and this is The Mortgage Voice. Each and every week we come to you, bring you information about what's happening in the world of mortgages. One of my go-tos is Charles Giscombe, who's from USF, and he joins us again today because I wanted to ask him a number of questions about changing conditions in the market and product out there that you can take advantage of. Charles, how are you?
Great, Jeff. Thanks for having me here.
Thank you very much. Chuck and I are both big basketball fans, and I liken what's happening in the mortgage market a lot to some of those lower tier teams in the NBA. They play hard, but they just can't seem to get over the top. That's a lot what we're fighting in the rate environment we have right now. So, we're almost at 8%.
We certainly are, Jeff.
Right?
8% is slowly creeping. Yes, sir.
Yeah. I mean, 8%. I just didn't think. I mean, earlier, about 2 months ago, I said, we might get to 8% by the end of the year. It just seems to be the way we're going. It's like gas prices out here in California. We're now at over $7 a gallon. I mean, so we've got gas and we've got mortgage interest rates, both out of control. Well, what do you see as the best way by which you can help your customer when they're looking for a loan? Obviously, you're looking at rates not being the answer. What is the answer? Programs?
You know what? First and foremost, Jeff, and it's a great question. In the market right now with all our clients, and I'm talking actively as of today, the most important thing we can do is be honest. Honesty is going to be the best thing. And when I mean honesty, I mean explaining to the clients, because we have to look at them as though they're not as versed as us, so we have to break it down to and let them know. These are what the interest rates are. And the market may get worse. So the reality of it is these are where the interest rates are. So now when you're making your decision and selection on real estate and different things, we have to be clear on the fact that no one, not even our 780, 800 FICO score borrowers, are going to be a get around the higher interest rates. Now, obviously, they can do a little bit better. I gave some at 7.25 today, 7.375. But for the norm, on a second home in Texas with a borrower with a 740 credit FICO score, they had an 8.625% interest rate.
Yep.
So people need to understand that that's where we are right now. But what we can do to combat those situations, after we explain to them the reality of the market, it will get better. Usually it gets worse before it gets better. So that's what we're going through right now. We're going back and forth with the rates. Pricing's changed for the worse. We're seeing a lot of those emails come across as us industry professionals see those emails. But what I will say is there are different things and different programs that can counteract the higher interest rates. And what I explain to them is I tell them about the interest rate, and then I tell them, but there's other options. There's 40-year loans. There's other loans, interest-only loans that you can take in short position so that you can prepare yourself and weather the storm of the higher interest rates. And then we can strategically have a plan together to get you back into the lower interest rate loans at no cost or no prepayment penalties to you to get back into those. And so when you explain how it is, then you can now have to go through the whole strategy and what your short-term and long-term goals are when you're giving a recommendation to your client.
So what I'm hearing you say is this is a ton of work to get a loan done, because not only do you have to explain where we are, but how we're going to get you to a lower payment over a certain number of months or possibly years before interest rates fall. And unfortunately, you and I both know they fall hard when there's a recession, which nobody wants because, that's your livelihood. People earn, earning money, paying rent,
Correct.
paying mortgages, eating. It's all on the food, all on the job you have right now. So,
Correct.
given all this information in your head, conveying that to the client has got to be, a lot of work, a lot more work than it was 2 years ago.
Yes, it's when you got to put your high boots on, Jeff, and you got to get into the deep water. And this is where your relationships and the trust that you have between the clients that you newly have and your clients that you've had formulated a relationship with. And that way, you earn the trust so that they trust that what you're telling them is real and that you truly have their best interest at hand. I find out that when the market and the rates are extremely low, the less explaining and communication you have to do. You have a low rate, we're good, get me into a low rate, I want to get this property, I want an all-time low, and then that's it. But now, when you're into the deep water, it's when you really have to gain the trust of the individual, and they can see that there is, gold at the other end, of the other side of the tunnel, and they can say, okay, you have my best interest at hand. Everybody's pretty much going to have to go through this low, but you'll follow me through, and you'll see me through to the other side. And that's what I tell all the clients now. Hey, listen, this is just what we're doing right now to get into the property, what we'll do later. And when you want to pull some cash out, this is what we have to do now. But at the end, we'll get you to the other side because the rates will correct themselves. They may not go down to all-time lows, but they will get back down low.
Yeah, I think that's true. We've seen it enough being in the business for many, many years as you have, and especially in the different jobs that you've held throughout the industry. You see where it is. The one thing that's always bothered me, and it's the same thing with gas prices, is that why is it that the rates are actually going up? Usually rates go up when there's a risk in the economy or that money is tight. Is money tight? What's the risk? These are the two things that are the base by which I look at a problem. Obviously, it has to do with the 10-year. Obviously, it has to do with other constraints on the economy or on lenders in general, whether it's raising interest rates because on the overnight rate. But what is it exactly that's causing rates to rise?
You know what, Jeff? It's an interesting question. And usually in this business, we hate to get into it.
Right.
We don't talk too much religion, and we don't talk too much politics. But I will tell you this.
Yep.
The uncertainty in the political realm causes some hesitancy, causes some fear,
right.
Creates a little havoc, which that will also cause us, with the threat of the government shutting down. These different things take a turn on the market. And what I mean by that is Wall Street and the different money markets that money's invested to that runs this world. At the end of the day, when there's uncertainty there, you're going to see uncertainty in the market, which then will have everybody covering themselves and hedging them bets. And when you're hedging bets in the market side, it means rates will go up. Okay? So at the end of the day, that's what we're facing. So what we have to do is we have to be all-encompassing as loan professionals, letting individuals know that, unfortunately, politics does play a part in this. We will get through this. It happens on a regular basis, but we'll make it out of this situation and letting them know, basically, this is what controls the market. This is what's happening right now, and explaining that to them. I think that if you explain that to them and you're honest with them, then at the end of the day, you can settle them, give some warm and fuzzies, and then we can move on to get into the business of loans ahead.
Yeah, well, I spent some time earlier in the show just talking about the distractions that you get, especially like whether you're on any of these social media sites and somebody says something that irks you and all of a sudden you're jumping into it instead of focusing on the exact thing that you need, which is housing and the best rate and what's the program. And I think what you're saying is pretty much the same. I mean, we can get involved with why things happen the way they are, but can you afford the monthly payment at this rate is really the question. And then, of course, are there multiple offers and how do you get the property? But that's a real estate question, so.
Correct. And that's exactly what it is, Jeff. That's a real estate question.
Right.
And then our job is to say, hey, listen, We know we know that the rates are high. We know things are changing. At the end of the day, we have these value-added services that we can add to our loan products that will allow you to counter and offset the high interest rates that can make that your monthly check stroke as low as possible to meet your financial need. That's what the key is after all this is said and done. Do we have other alternative options that will allow individuals to still write the lowest possible check and to feel comfortable? And at the end of the day, not to feel cheated or forced to be in a bad situation, Jeff.
Excellent. Right. That's exactly what, we can't control it, but we try to make the best of it. And I think, that's what you're talking about. Listen, we've come to the end of it right now. So you want to shout out a way by which people can get a hold of you and all the great services and products and states and places that you do business?
Appreciate you, Jeff.
Thank you.
You can reach me at 702-328-5191, 702-328-5191, or you can reach me at Giscombe at usfwholesale.net.
Excellent. Thank you very much, Charles. Thanks very much for coming on the show, and we'll talk soon.
Thank you for having me again, Jeff.
Thank you. That's Charles Giscombe from USF. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we come to you from a number of different sites, podcasts, websites, all kinds of different things. Certainly the YouTube channel, Jeff Barton, the Mortgage Voice, which we've been on for years, hundreds of shows there, archived, going back, we've been 10 years, so they must have at least 6, 7, 8, 9 years of shows on there. And you can see the trend or hear the trend by which the mortgage industry has gone through during that time. It is stupendously different than what it was even obviously a year and a half ago, 2 years ago, and probably will be that once again once we get 2 years in the future. So it's a good reason to listen to the show because we can bring you up to date and certainly be there as a advisor or somebody who can really walk you through what the tough times are, which they are right now. With us, once again, I'm very happy to have Maria back. Maria Schroeder from the Lending Pros joins us. And first off, Maria, how are you?
Good, Jeff. Thank you. How are you?
I'm fine. Thank you very much. It's been a whirlwind out there with rates the way they are. And as Maria and I were talking off air, she was mentioning one of the products that they have at the Lending Pros, their standalone second. Give us a little idea of what that is, what it entails, how do you get approved for it, all that.
It's a great product right now, especially in the rising market, and
right.
Especially people who took advantage in the last year and a half, 2 years ago with the low rates, historical low rates. It's, people feel like they're a prisoner. They don't want to lose their interest rate, but they have equity in their house because they might want to buy another investment property or do home improvements. And now, all the lenders in the mortgage community is answering that with a product where we can do a standalone second with full doc, even with people who need to go bank statements to prove their income, even people who were investors that did the DSCR, the business purpose loans for their investment properties, can now get a standalone second, and the blended rate is a lot better than the 7%. Like, we've done some tests where we take the 10%, depending on FICO score and LTV, of course, with their 2 or 3, 4% interest rate, and we're still blending it under 6, which is way better than the 7.5 rates out there.
Right, and that blended rate doesn't reflect the full price of the loan because usually these standalone seconds are a lot less than the first, right? So actually the blended rate is less.
Yes.
Yes, and that's why. Interesting.
And we're also offering like 30-year amortizations on these seconds, which will help people afford these loans better. So, the lenders out there are listening to people's concerns and needs and trying to come up with answers.
So I like the idea of the standalone second. I'm not sure I understand the qualifications and the costs and the rate and how that's all figured out, but certainly being able to take money out of your property because, like you say, you get to be a prisoner in in the rate that you already have at 3-4%. You're not getting out of that, so you're not refinancing the whole thing.
Correct. So they don't get to lose their, typically these seconds are anywhere from 100,000 to 500. And so if, and your first mortgage is typically double that, if not triple that, right? And so you get to keep your low interest rate on the majority of the mortgage that you hold on your property, and then be able to access some of your equity to do whatever whatever people's dreams are to do.
Right.
And then the fees are standard with us, right, which is the lenders. And if people choose to buy down their rate, that's, a different aspect of the cost that can increase. But your FICO score, your LTV, we go up to 85% CLTV, so you can access up to 85% of your equity, combined with what you currently own, obviously, and that will determine your interest rates. And the rates are ranging from high 9s to high 11s.
Okay, and that's all probably FICO driven, income driven?
FICO driven, yeah. Minimum FICO score of 660 or better. And then obviously the type of income documentation, how you need to qualify. People with full doc, with full tax returns, they get, better interest rates. And then there's the risk factors if you're a business owner and you have to use business bank statements, and at that point, it's a business decision, right?
Yeah.
Do you pay more in taxes to qualify for a loan or
Right.
take advantage of your taxes,
Do you
right
see
off.
the lending environment that's created by obviously rising interest rates as a strain on the ability of the lending standards themselves? Are they harder to get is it harder to get a loan today than it was 6 months ago? Not rate aside, I'm just talking the standards by which documentation is required.
No, I have not seen a whole lot of change in underwriting.
Okay.
What I've seen as a wholesale lender working with a lot of originators, their biggest frustration is inventory.
Right.
And the fact that, hey, rates are low, there's no benefit, to refinance out of it.
Right.
And then also the other thing is if there is a benefit when you're doing a cash out, hey, I'm going to lose this, 2% rate. So now there's an answer to that,
No, I happen to like the second versus the home equity line of credit. Do you do the home equity line of credits as well?
No, but that's soon to come.
Okay.
So probably if not by the end of the year, definitely by the first of the year. That's already management and market, secondary marketing is already saying that that's coming down the line. But we're one of the few lenders out there that came on with the closed-in standalone second.
Okay. Hey, you mentioned secondary market. I wanted to ask you a question about that. The appetite for these types of loans, obviously there's appetite out there to buy any loan right now because there's not a ton of it. But at what point is it a detriment to hold a lot of this paper? I mean, do you hold them to sell yourself? Do you sell them off to an investor? How does that work?
We're selling them to an end buyer who's securitizing it.
I see.
Is what I was told.
Okay, yeah, because when we're doing a lot of jumbos at 3%, 4%. Those jumbos are now albatrosses around some of these lenders' necks. As we all know, liquidity is a big deal. And if you've got caught upside down by which you cannot securitize those loans anymore, you're out of the loan business. So I was just wondering how this was working in the secondary market with seconds. Is there an appetite to buy them? And, of course, that would replenish your ability to go out there and do more seconds.
Correct. And from when they rolled it out, our secondary marketing and our person who did our training and educating us all to market it correctly, they kind of had an understanding that these, even though we're doing these rates in the high 9s and as high as, 11.99, these aren't going to be loans that a lot of people are going to hold forever, even though we offer the 30-year amortization for qualification ease. They just think that within, nobody has a crystal ball, but they're thinking and hoping that they're accurate in thinking in the next 6 months, rates will go down, hopefully in a more reasonable fashion in the 5s. And then, people can, then it would make sense for somebody to do a consolidation of the first and second.
Now, the Lending Pros themselves as a company, how long have they been in California? And maybe I'm just got my head in the sand, but I don't recognize the name off the top of my head.
Our parent company is OCMBC, and they've been around for 25 years.
Right. Okay, I know that name. Okay, so and the Lending Pros is specifically here in California, or are they in all 50 states? Yes.
We're in almost 50 states.
Okay.
Yes, minus 2, so 50 states, and then or 49 states, and we're located in Irvine, California.
Excellent. Why don't you shout out a way by which people can get a hold of you and maybe take you up on some of these great programs that you have down there?
Okay. My number, people can contact me at 949-878-7045. I would love to help anybody with any guidance.
Maria, thank you very much for coming on the show, talking a little bit about what's going on there. And as we have gone into depth a little bit, the second mortgage, I think it's a great program, and I think people should take advantage of it. But thank you very much for coming on the show.
Thank you for having me. Have a great day.
Okay, you too. That's Maria Schroeder from the Lending Pros. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning into the show. Each and every week we come to you, we bring you some solutions, we ask a lot of questions, we present material that is out there, and some of it is interesting in that it does affect your psyche and how you plan to go about buying a house, refinancing, purchase market. Not a lot of refinances right now, unless you're absolutely desperate, and there are those people out there who are. Anyway, you can see and hear this show each and every day. If you go to kcaa.com, archive, Jeff Barton, the Mortgage Voice, you can, like I say, hear last week's show, the week before that. You can see me. You can also go to YouTube, Jeff Barton, the Mortgage Voice on YouTube. We're on any number of different podcasts, as well as themortgagevoice.com. These are all the different ways that you might be able to get in touch with me. And certainly, if you're listening to the show each and every week, you're a fan, sign up, click the button, hear the bell, all that kind of stuff. Anyway, bringing us better information about programs and products in the mortgage industry is April Lopez, who's been on the show from its inception till today. I don't know, that's not dating you, it's dating me. Anyway, April from Nations Direct. April, how are you?
I'm doing great, Jeff. Thank you. Thanks for having me on the call.
Thank you very much for coming on the call. I've always relied on your information as well as your steady hand at what you are saying, because it's gospel in terms of whatever programs are available out there, some of the things that are making headlines in the real world, maybe not as important here in what we do on a daily, whether it's interest rates or whether it's demand. So we're talking a little bit about what is happening in the market with the rates going up as the way they are. What are you doing at Nations to try to solve some of these problems for borrowers?
Well, Jeff, what we're doing is a couple of things. As the interest rates are continually increasing, what we're finding more and more is this non-qualified mortgage, second mortgages that we are closing a lot of, and a lot of these buyers or borrowers who have mortgages that are in the high 2s or 3% range and need some cash or want to take the opportunity to just liquefy, they're going to get second mortgages. And these second mortgages are actually closed-in seconds that are amortized over 30 years with some really aggressive rates for a second trust deed.
Yeah, they're doing a lot of the 30-year seconds. Is that new to this market in particular, or have they been around before?
You know what? We've seen in the beginning of maybe at the end of COVID, we started seeing HELOCs. We never really saw closed-in second trust deeds, so a lot of people look for HELOCs. But, in an increased rate market, HELOCs are not favorable.
Right.
So they are now more popular, these second trust deeds. There's one investor, maybe two, that are purchasing these up. So you're going to find that the guidelines to qualifying for these seconds are going to be pretty synonymous across the board.
Yep.
And they're super popular.
Yeah, that's interesting that you say that. We've had some different people on the last few weeks talking about the seconds, and of course, I always ask, and you've already answered. Who's buying these things? I mean, are you gonna get stuck with them? Are you going? How is this going to work out? Because we all know that the jumbos that were given so readily at 3% really hung like an albatross around a lot of lenders' necks when the rates went up because they couldn't sell them, couldn't really monetize what they had, and so now they're scrambling to find ways to borrow money to be able to lend it out and make money. What's your opinion on that?
Well, I think that, the second trustee investors, there's two. I can't recall the name of the first, but Vista happens to be the big player in the second trustee purchase market.
Mm-hmm.
But I think that what they're finding is, the rates are high. They feel that in some point in time, if the rates should come down in the near future, that they're going to be refinanced out. And they feel good about the fact that the first trustees are at lower interest rates, so they feel very secure. They are, making sure that what's really nice too is they've opened it up to not only primary residences where borrowers live in the homes, but they're opening it up to investment properties
Right.
and second homes. So with inflation being around and the cost is increasing, they want to be able to give people more cash to be able to take care of their needs.
Yeah, I think cash is really, the watchword. Obviously, the economy got some reports today, some things are looking good, but there's always the dreaded R word, recession, always on the horizon. Will it continue? Inflation, all these things. But cash seems to be the king. And so having your access or ability to get access to equity in your home is a big deal, especially if you've got uncertain future financially. Either you're retiring or maybe some of your other investments aren't panning out because of for whatever reason. Your thoughts on that?
Well, yeah, I mean, I think that 100% cash is king. And what we're also finding, too, is that this non-qualified market where loans, you had mentioned about jumbos. So we're starting to find with the agency rates being so high that now this non-qualified market's coming out and they're saying, we're going to give you very competitive rates in the 8.5% range, approximately, even better than maybe your agency high balance rates. And we are going to be aggressive with it. And they're reaching loan amounts, which are jumbo loan amounts up to $3 million. So they're actually allowing more of these type of buyers who are self-employed, who might want to qualify with bank statements, the more opportunity to come into the market and either cash out or purchase homes. And they're coming in and taking a little bit more of that market that the agency is trying to shy away from.
Oh, that's interesting. So you're saying that in the non-QM world, the actual jumbos are competing directly with, the conforming jumbo rates.
100%. Profit and loss loans right
Yep.
now, bank statement loans, they're pricing actually better than a high balance conventional agency loan right now.
Why is that? Is it just because there's no appetite for it in the conventional world? Or
Yeah, I think because of the mortgage-backed securities, everyone, doesn't want to have that much exposure.
Yeah, that's
and
right.
Yeah, and they're coming out and saying, hey, we feel strongly these borrowers can qualify. We want to be able to lend to them because in the future they know, it's going to be worth money. These high coupon rates are going to be worth something down the road, and they're going to try to make a premium on them.
Yeah, if they, as you say, when rates drop, everybody's going to refi again. So that's a double good thing for the lenders themselves because they're guaranteeing that these particular rates will be paid off and they'll be able to get the money and lend it out again. Do you see the second market as a temporary thing or something long-lasting? Because, usually you never hear about it in seconds. Yeah, people get them, but it's not as popular as they are today for obvious reasons.
I think they're going to probably be around and probably till the end of next year. At the very minimum, because I feel that, we have seen, I think we're going to see rates kind of end up in the 8s. I almost think that the rates probably will be in the 9s before the election comes around, things settle a little bit. And then once things settle and we get more of a perspective of how things are going to be going into 2025, I think then the seconds will probably go away because we're going to have probably a refi boom come.
Well, then obviously you're saying recession at that time because there's no reason for rates to drop unless there's some stimulus needed in the economy. And usually that happens when the Fed lowers their short-term interest rates, and then the mortgage rates shortly thereafter follow. Because people fly into treasuries, and it means that they cost less, so that the actual yield actually lowers too. So, yeah, it's very interesting. So is this a brain trust over at Nations thinking this, or is this just you based on your experience?
I just think it's me based on
Right.
the current events. And, it's interesting because we would have had this conversation 4 months ago and I wouldn't have really had the same perspective.
Yeah,
but
me too. Yeah.
It's crazy. Diamond comes out from Chase and he speaks about,
Yeah.
the change in the Fed fund rate going up 2%. And that plays a huge role. And if you've got Diamond from Chase saying, hey, the Fed fund rate is going to go up 2%, we're going to be in the 9% range.
Yeah. No, that's true. And he's a scary guy in terms of not a scary person per se, but what he says really affects markets. And
Yeah.
I listen to him probably more than most of the CEOs at the major lenders anyway. He's been around since, the crash and of 2008 or even before, and has seen the ups and downs. And obviously we're in one of these markets whereby if he says that, it's probably pretty close to true.
Well, that's why you saw the market react to that as well.
Yeah,
and so,
I did.
People are like, okay, he's on to something. And he historically, he's proven that he has, good insight and he's been through it to have some better understanding than most of us, right?
Yeah, no, absolutely. And I think the inside track of it is that, hey, he talks to all these people all the time. It's not like they're in a vacuum over there at the Fed. And it's not like, whoever it is that's running the Economic Council at the White House, they're all talking to these people. So I think it's all something to pay attention to, especially when someone like that. It's like when Buffett speaks, same thing. You listen because you'd be stupid not to.
Yeah, 100%. So it is scary, I will tell you. But what's interesting? We're in a macro supply.
Yep.
So you've got these millennials and these Gen Xs who are the ones who are buying, but the affordable homes for them are not available.
Right.
So I think that you're going to find more of them reaching out, into the more affordable areas in order to accommodate. And people still need places to live. People,
right. All that's true.
And,
yep.
Yep. And the values aren't going down.
No.
So, people want to say, it's just because inventory's low.
Mm-hmm.
And you don't have sellers who want to sell right now.
No,
that's why it's going to keep.
The formula that we usually look at is gone. And we're up against it here, so I want to have you back to continue to talk about this because, we can't talk rate and we can't talk really programs because everybody has similar issues when dealing with their borrowers. But we can talk macro strategy of what's happening in the economy and why. And I'd love to do that some more. But like I say, we're up against it. And if you could give people a way by which they can get in touch with you about this second program, that'd be great.
Absolutely. April Lopez, Nations Direct, 818-398-1272.
Thanks, April. Thanks very much for coming on the show as always. You're real supportive, and I deeply appreciate it.
Oh, always a pleasure. Thank you for having me.
Thank you very much. That's April Lopez from Nations Direct. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. We are on a number of podcasts thanks to our KCAA affiliation. If you go to kcaa.com, you can actually see and hear the show too. However, if you want to see and hear us in the podcast world, and like I say, we're on plenty of them, Darryl has a terrific list.
I sure do, Jeff. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and TheMortgageVoice.com.
Excellent. All of these places where you can see and hear the show. We've been on air for 10 years, and we have archived in all these places many, many different types of shows. One of the interesting things that I do is listen to other podcasts. I think that's become really popular. I'm going to try to grow the podcast base by which this information that you're receiving free of charge over the air on KCAA radio waves. I just think having perspective on information, especially in this very specific niche, which is, look, we're going to talk about mortgages. We're going to talk about your real estate deal. We're going to talk about programs with the people we bring on the show, and we're going to talk about some of the macro issues that might affect your rate on the segments that I do. It's a pretty simple, straightforward, but I think the information is important, and I think where you get it and how you get it has to be plentiful and, make sure that it's all over the place. Obviously, YouTube, you can go there, and all these podcasts. There's one podcast place in particular, podclips.io, which is a centralized place where you can go to find all kinds of different podcasting groups and people. There's some dispute resolution podcasting people. Who are those guys called? Because I think they're great.
Yeah, it's the mortgage, not the mortgage. It's ADR, which is an organization of people that do these sort of litigation techniques, which are Levy is the guy that does the show.
Yeah, and all of these, if you're in a real estate deal, there's always that clause in the contract that says, okay, if you get into a dispute, do you agree to go to mediation and then arbitration? That's what these people do. They either do the mediation part or they do the whatever it is, the ADR part. And when you get into that particular type of negotiation, it's better. Now, you can... It's funny. There's something that bleeds into this right now. Today was a banner day for a couple of things. NAR, National Association of Realtors, was sued by a couple of groups. Now, we talked about it about 3 months ago, and the lawsuit was, hey, I'm a seller's agent. Why should my seller be paying the buyer's agent? Why should that happen? And it really was about what NAR was saying, that in order to be a National Association of Realtor member, you had to offer a commission to the selling agent. The selling agent is the buyer's agent, right? Well, the lawsuit said, no, we don't have to do that, and we're not going to do that. So the one was by RE/MAX and one was by Advantage Group, and they settled, or the settlement is up for approval by the judge that's overseeing the case. And it basically said, okay, we're going to offer for buyer's agents, seller's agents can now offer 0% commission, meaning that you don't have to have a commission sharing agreement because NAR says you do. You don't have to do that at all. So it's going to change a lot of what happens and how representation happens with you as a buyer or you as a seller. It means that for the seller, it's probably going to be less cost. Like, let's say your average commission is 5%, 2.5% per side. If your average commission is 2.5% now, or 2% or 3%, then that's all you're going to have to pay. Let the buyer's agent get the money from the buyer. And so in terms of the enforcement the NAR has, National Association of Realtors has, over the way contracts are written, that is now going to go bye-bye. So in that, the way that the buyers and sellers agree to pay each other or pay each other's agents, that really is going to change the business model. Now, will it be a boon for buyers, a boon for sellers? It's going to make a lot of buyers want to go directly to the seller's agent. Why? Because they don't want to pay. They don't want to pay the buyer's agent. They don't. So this is going to shrink commissions overall, and it's going to force the listing agent to take on more of a responsibility by representing the buyer as well. That's what the upshot of this is going to be. It's going to limit the ability for a buyer's agent to be able to attract customers, because the old way to do it was, hey, you don't pay me, the seller pays me. Now that's no longer the case. Now, it may take a while before that grabs hold, but as soon as somebody sees that as an opportunity, you will see new ways by which commissions are paid, and therefore you will see new ways by which business is done. So in this podclips.io kind of explanation, I just think that all of this information that you can get from anyone, whether it's on podclips.io or me, at the number of different ways that you can get a hold of me, listening to me, yeah, very, very important. Okay, so interest rates, let's get right to that. 7.84 is the interest rate on a 30-year fixed-rate mortgage for Fannie Mae and Freddie Mac. Let me repeat, 7.84. So we're at 8% territory, folks. Wow. 15 years at 7.14. The let's see, what is this? This is FHA is at 7.23. The Jumbo's at 7.90, and the 5-1 Arms at 7.12. There's no more sixes here, if everybody's noticed. Now, over the last 2 weeks, last week I was off, we repeated the show, but it has gone up about a quarter point and is staying there. Has little to do with the Fed, has a little to do with the 10-year. The 10-year itself is at 4.8%. Now, we had flirted 10-year at 5%. The 2 years at 5.1 already. And as I said, these are great investments. If 5 years ago you would have said you could have got a 10-year at 4.8%, you would have jumped at that. 4.8% guaranteed buying U.S. debt? Absolutely. But right now, the 2 years at 5.1, that's even a better deal. Okay, so where? HELOC. Okay, so in the marketplace itself, what are we doing to increase the ability of having new and different products on the market? We know that the purchase market is shrinking because there's fewer and fewer things to buy and fewer and fewer housing to buy in any neighborhood all across the U.S. And there are very few neighborhoods across the U.S., we'll get into this next week, where prices are predicted to be falling or are falling. But in our neck of the woods, which is, of course, San Bernardino and Riverside counties, they are not falling. They are maintaining or gaining. As I said, rising interest rates are not killing rising prices. An anomaly, really, hasn't really ever happened. Usually prices go up, demand gets killed. Not in this market. So what exactly are we doing with product? Product itself, and what are my colleagues and I in the mortgage business able to do about it? Well, obviously seconds, right? We're talking about HELOCs. Can you take money out? You've got equity built in. Can you get it out and use the money to either, there's many reasons why you take the money out, but HELOC is one of them. Second mortgage, absolutely, that's another one. Shared equity contracts, yep, that's another one. AITD, that's another one. These are all ways by which you can either sell the property or be able to take money out, gain equity in cash rather than in property in this particular market. Now, where are rates headed? Oof, we're going to ask a bunch of people today about that because we're just trying to figure out, because rates have risen so quickly over the last 6 months, exactly what the demand is at this level. We thought 6.5% to 7% was the ceiling. It's not going to be the ceiling. We're looking at 7.5%, 8%, and maybe beyond. Now, I had predicted a bit earlier in the year, maybe 3 months ago, we'd probably see 8% by the end of the year. Well, we may even, supersede that. A couple other things. Jobs report, 336,000. I said that. The wages year over year up 4.2%. Unemployment rate is at 3.8%. The participation rate in the economy is at 62.8%. That's good, but not great. The jobless claims are 207,000 this week. It's a slight increase. The tightening in lending standards, Fannie Mae to increase loan-to-value ratios for purchase and refi on multi-unit buildings. This is Jeff Barton, and we will see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.